Welcome to the midweek market update where I do a technical analysis and give you some of my thoughts on SPY the Qs and IWM. I've also got 5 trade ideas for you at the end of the video, so stay tuned. Jumping right into our S&P analysis, starting off with our sectors as always over here on the left. If you're new, leading the pack today was the tech sector, XLK, up about 1.6, which, as we know, is the heaviest weighted sector in the S&P, so it's no surprise that we were green for a majority of the day. And then leading the pack to the downside, the XLF, ironically enough, the second heaviest weighted sector in the S&P, leading to the downside there, about 0.75 of a percentage point. So all things considered, the push and pull between the two sectors was definitely there. But in terms of which one carries the most risk at this point in time, I would say, although it was up the most today, it's still the tech sector, okay? It's not the financials. Let's check in on those charts, actually, and just sort of walk through this here. Something I want you to keep in mind, just burn this image into the back of your brain for a second here. Keep in mind this resistance trend line, okay? In tech, in the S&P, this particular sector of the S&P, right? We poked our head above it, and then we closed below. We also are getting tangled up in that 50 SMA here. And again, take a little mental snapshot of that because you'll see it's a different story when we look over at the NASDAQ through the lens of the Qs. But for now, again, unless we can really get going above this resistance trend line, right? Unless we get some serious strength above it, some closes start to close above that, then again, I think it just poses the most risk to the S&P as a whole, to do something like this and pull back into this extremely choppy range that absolutely no one has liked trading over the past week and a half or so. I mean, it's just been absolutely brutal trading back and forth in this range, having no follow through to the up or downside after some pretty, convincing looking moves, right? So tech sector, in my estimation, still is posing a threat to the S&Ps until we can get a solid close over this particular resistance trend line and, resolve that 50 SMA. The financials, on the other hand, again, if we just check in on something like this, it's really not, it's nothing, in my estimation at least, to worry about just yet. If we draw in a consolidation range like that, we just closed right about at the halfway point, right? So just consolidating, just going sideways, and especially digesting an extremely impressive move off of these lows here since early February, right? So tech is providing the risk and financials just sort of cooling off. I don't really think there's a major risk to any downside unless we were to revisit the bottom end of the balance and potentially threaten a breakdown there. But again, that's just not in play as of right now. One thing I want to mention while we're talking about financials here is the TNX, which of course is the 10-year note, which we've talked about for quite some time, and how it's good for financials for it to be going up and bad for tech for the 10-year note to be going up. However, look at the correlation here. I would argue that it's broken, right? And we've sort of hinted at this in last week's video, but definitely today, you can see it clear as day. We had a green day here in the 10-year note, and tech is still up about 1.6, and financials are actually down about 0.75 of a percentage point. So I would say the correlation is not as strong anymore between the TNX and your, technology sector. Just something to keep in mind if you were sort of keeping an eye on it as you were trading throughout the week. Let's move back over to the SPY daily chart and talk about some of these candles here. Of course, came very, very close to the all-time high today. We were actually stopped at 3.98 the whole dollar to the penny here on today's trading session in the SPY. But basically what I want to get at here is most clearly illustrated through the market profile. So we'll just very quickly go through levels here. On any pullbacks, we really want to see the top of last Friday's range, of course, hold, right? That's around 395.60. Anything underneath the line in the sand now, instead of being down here at 388, I would call it actually here at 393.25. And again, we'll look at that in much more detail in the market profile in just a second. Of course, to the upside, you're looking at whole and half numbers, blue sky territories, and of course 400, the psychological magnet. Will it happen on a shortened trading day on Thursday before a holiday Friday? I'm not entirely convinced, especially with the upper wick that looks something like this, but 400 is still definitely on a lot of people's minds. Moving over to our market internals now, the main thing, again, if you're not familiar with this screen, get familiar. Go ahead and check out this video. I explain everything here, how to set it up, what it all means. But most importantly, what I want to make note of for today's video is the fact that volume was extremely low throughout the trading session. And again, holiday trading week, who knows if that's the reason or if there's just not a lot of buyers committing to volume up here. However, breaths never got anywhere close to 3-to-1 or 5-to-1 positive on the NYSE or the NASDAQ. They were pretty much hovering around, 2, 2.5, 1.5, somewhere in there. And, most notably here, never even got to 100 million, right? Never. And then, of course, into the end of the day, nice little dump that ended us negative for the session. So volume was just really lacking in today's session. The other thing I want to point out, again, call it whatever you want, attribute it to the shortened holiday week, but at no point in time did we really have strong correlation where there was a serious amount of stocks on the NYSE upticking versus or rather advancing versus declining. So no trend days so far in the ADD. And then the ticks tell probably the most bullish story. Of course, they're going to be skewed to the intraday data here, but the cumulative build really strong both on Tuesday and Wednesday. Wednesday, most notably, with our 12 o'clock read being at 2,000 or above. We knew a trend day was on hand. And again, we're going to skip right over to our market profile for the rest of the S&Ps because I believe it tells the best story. So on the market profile, all eyes, and we've talked about this in the Discord almost all week, have been on this spike, right? So the spike is telling us, that on Friday, right, we saw an extreme surge. That was no news, right? But as we traded into the week, we needed to determine essentially, are we going to accept these prices inside of the single print spike, or are we going to reject them? And obviously, through Monday and Tuesday's trade, we accepted them. And by accepting, I just mean that we spent time trading back and forth, two-sided trade, very important distinction there, not one-sided, two-sided trade inside of the spike, telling us that buyers and sellers agreed that this was fair value. Okay, you can see that the value area here was smack within the overall range of the spike. Okay, so as we accepted the spike and moved higher, that's the signal here that the market probably wants to go a little bit higher, right? If we found sellers in the spike, it would have been history, right? On Monday, we probably already would have went down and revisited Friday's point of control and then the 3,900 whole figure here in the futures, but it wasn't the case. So for now, we have to take it as it lies. We've accepted the spike, and now we're starting to break out to the upside. The only thing that I don't really like about today's profile, and again, it was on extremely light volume, the entire session, right, across the NYSE, is the fact that although the bulk of the TPOs, and that just means letters here, are concentrated towards the top, there's the point of control in terms of TPO, but the point of control in terms of volume is actually slightly lower. You can see this orange line is where we're trading now, and it's acted as a magnet and pulled us right back down towards it. So again, lack of volume is preventing me from being overly bullish here and considering, a large break into that 4,000 round number. But again, we have a poor high, something to point out as well. Usually they like to get repaired. The proper end to an auction is always on a bang, meaning that we see some serious single prints out of the top, emotional buying towards the top, and then that's how the auction ends, right? There's a lot of excitement and then it fades. It's not like that's just kind of This poor high up here is essentially okay? So that's some of the psychology behind the market profile and why I think that we probably, again, does it happen in a shortened trading week? Maybe, probably not, but into next week, I would definitely be slightly skewed to the bullish side, okay? So I think we've spent enough time here on the S&P. Let's wrap it up across the broad market with the Qs. Again, remember back to that XLK picture that I asked you to burn into your brain. You can clearly see the difference now in the Qs, right? We have a break of the resistance trend line, strong move above, and now I think that, clearly it's the 50 SMA, right? If we can trade back above that, looking for a move to the top end of the sort of neckline of the inverted head and shoulders we've been talking about for some time at 324. After that, the gap fill, again, short and trading week. Does it happen in one day? Probably not. To the downside, if we pull back, again, this is sort of the critical takeaway here in my estimation of the Qs. Now we really need to hang on to that 317 quarter. It was a super resistance trend line as well as a horizontal level. And now that we've broken it, I want it to really show that we're holding that with some strength, right? So a break of the resistance trend line here through strength and consolidating above now for something like that, as opposed to just choppy through time, right? If we do something like that, the break becomes less meaningful. So that's pretty much my focus here on the Qs into the end of the week. Do we hold 317 quarter? Lastly, moving over to IWM, Russell 2000, and our small caps. What would we be without them? Again, this one I would say probably just avoid it into the end of the week. Reason being is we're smack at the middle of the range, right? A little slightly skewed to the upside as opposed to being dead center in the middle. However, 50 SMA, overhead resistance here. It just doesn't really look good for a large break to the upside. Now, if the Qs and SPY really get going, I'm sure IWM will follow along. However, it wouldn't be my likely pick in what to trade, right? I would also avoid it short underneath the low, maybe tiny little small gap fill in there. But overall, I would avoid IWM until it picks a direction outside of this overall range and sort of resolves that 50 SMA here on the daily time frame. You've had enough time to pick out the levels, so let's go ahead and move into these 5 trade ideas. If you've enjoyed the video so far, go ahead and do me a favor and hit the thumbs up button. Consider subscribing to the channel, and let's keep going. The first trade idea is on BLK for BlackRock, which is, of course, a financial institution. So go ahead and keep a close eye on XLF if you decide to trade this one. The trade idea here is, of course, a daily bull flag looking for the breakout over 762, in which case we have a gap in the chart to potentially fill. So the gap is from here to here, which is 765 up to about 776.85. After that, you're looking at the all-time high. Now, don't get me wrong, these are definitely inverted hammers right here. However, just like we were holding the spike in SPY, I would argue that the same thing is happening here in BlackRock. We have a huge breakout bar, and now we're at least holding, I would say, 50% or greater of that breakout range, which is why I like the bull flag, regardless of the inverted hammers that have printed on today's session and yesterday's session as well. Next trade setup is on CTSH for Cognizant Technology, and the setup here is extremely similar. Right, we have a pressure cooker top over this level at 79.27, call it 79.25. No gap to fill. However, the next resistance is a decent ways away, so enough meat on the bone here to make this trade worth it, up around $81 to the upside if we break 79.25. Next trade setup is on a good one, PZZA. Okay, so pizza. Get hungry for this one. Sort of an inverted head and shoulders, right? We have shoulder 1 over here, head down here, and now we're sort of hammering out this long-winded right shoulder. But what I like about it is it's going to offer a setup in both directions. Okay, so regardless of what the market does, there should be something to do here in pizza. It's either over our 89.65 area or under, let's say, our 86 whole dollar. Okay, so 200 SMA is sort of tangled up in there, but you'll notice, and I'm sort of slightly skewed to the bullish side here in pizza, if we do get the break, there's some room to run all the way up to the 50 SMA, which sort of coincides with a little bit greater of a range than a true double, right? We always talk about doubling the range. A double would probably look something like that. 50 SMA is obviously slightly higher than that. So again, there's plenty of room to run to the upside if we do get the break out of this range here in pizza for Papa John's International. Next one is on Twitter, so TWTR, and this is actually a bearish setup. So if the market rolls over, if tech rolls over, then you can quite clearly see here on this one, you have a resistance trend line, inverted hammer, and 50 SMA all tangling up on sort of the back test, right, of that prior support area there. Let's go ahead and put a value to those numbers, those figures there. I would argue that the support is probably somewhere in here around 64.50. Again, this is the back test of a broken support, so touch 1, sort of resolved it here, got a small little bounce towards the end of the day on that red candle. Now that we've broken it, there's your back test. Going lower, first target would be the lows of this most recent leg down. I would argue it's probably 60 the whole dollar. You probably don't want to overreach too much. Obviously, the trend is still up here. 50 SMA is pointing up. 200 SMA is pointing up. You don't want to fight that too much, but definitely a short duration, short trade available in Twitter if tech rolls over. And then the last one I'll leave you with is on CHWY for Chewy. And these guys reported earnings just the other day, and obviously that led to this massive gap up. But look at how weak this candle closed even after a massive gap up. And most importantly, we had prior market structure here. If this was going to stop anywhere and hold the gap, I would have argued that it was going to do something like that. Okay, so because we've closed weak, because we've closed back in the range, if we start to move lower in tomorrow's trading session, let's break it down to like a 15-minute chart here. If we start to move lower, just look for the gap to fill, okay? And the gap fill is to this area here. Let's go ahead and call that out at 81.63. Of course, it would be a trade underneath 84.75. You have some moving averages in here, but there are no major daily moving averages that you should pay attention to. So again, look at how weak it closed. If it was going to hold the gap up, it would have been right here, as we mentioned on that daily perspective. So that's going to wrap up today's midweek market update episode. Again, if you enjoyed the video, learned anything new, feel free to let me know down below in the comments section or by simply leaving the video a thumbs up. I wish you all a green rest of the trading week, even though it's only one day, and I hope to see you all in the weekly watch list on Sunday.